Okay, you've sold something for more than you paid for it. A stock, a property, a piece of a business. That difference, the gain, is great news, but it also creates a question that catches a lot of people off guard. How much of that gain is actually yours to keep? The answer comes down to capital gains tax, and one distinction inside it changes the outcome more than almost anything else. Let's start with the basic idea. A capital gain is the profit you make when you sell an asset for more than you paid for it. What you paid is called your basis, and what you sold it for is the sale price. The gain is simply the difference between the two. So if you bought an investment and later sold it for more, that increases your capital gain, and it is that gain, not the sale price, that the tax applies to. At Avion Wealth, this is a point we're slowing down on, because people often assume the tax applies to everything they've received. It normally applies only to the gain on sale. Now here's something that many people don't realize. A gain on paper is not the same as a gain that is taxed. If you own something that has growth in value, but you have not sold it, that is an unrealized gain. It exists on paper, and in most cases it is not taxed until you actually sell. And that makes sense when you think about it. Your asset may go up and down in value prior to sale. It makes it very difficult to estimate or even refund the tax on the gain on an unsold asset. This is, in fact, what makes a wealth tax unworkable in real time. The moment you sell is when the gain is both realized and measurable. Now that distinction matters because the timing of a sale is one of the few parts of this that a person may actually have some say over. Now to the distinction that matters the most once the gain is realized. Was it short-term or long-term? It really comes down to one thing, and that is how long you held the asset before you sold it. If you held it for 1 year or less, then the gain is generally treated as short-term. If you held it more than a year, it's generally treated as long-term. So who cares? Why does this even matter? Because the two are actually taxed very differently. Short-term gains are generally taxed as ordinary income at the same kind of rates that apply to your paycheck. Long-term gains are generally taxed at lower rates, designed to discourage short-term speculative behavior. So two people can sell the very same asset for the very same gain and get to keep different after-tax amounts. For example, an 11-month gain is short-term, whereas a 13-month gain gets favorable tax treatment. And that is how much the holding period really can matter. For the people that we work with, capital gains rarely show up in isolation. They show up when a business owner sells the company they built, when an executive exercises and sells equity compensation, when a family sells a property held for decades, when a concentrated stock position finally gets diversified. In each of these moments, the size of the gain can be significant, and the questions around timing, holding periods, and coordination with the rest of the tax picture become worth genuine attention. These are the situations where a gain deserves review well before the sale, not after. Capital gains tax is rarely just a tax question. It touches when you sell, how you sell, what else is happening in your income that year, and how the sale fits the rest of your plan. When those elements are considered together and coordinated alongside your existing legal and tax professionals, the outcome tends to reflect a decision rather than a surprise. If you're navigating equity compensation, planning around a concentrated stock position, or approaching the transition into retirement, and you want a clear picture of how the tax picture fits within your broader wealth strategy, Avion Wealth offers a complimentary second opinion service to address just these questions. It is a review of how the pieces fit together, and it comes with no obligation. We wish you the best of investing success. Thank you.